So like I say, I'm Dan Coatsworth, and I'm just going to give you an overview of how you can go about finding stocks that fall under the value sort of territory. I'll also talk about how to find investment funds, investment trusts, and some tracker funds or exchange traded funds. So now there's just a quick disclaimer, because I will be discussing some past performance things. So if you just bear with me, I'll just quickly go through the highlights of this. Again, we don't offer advice. Go and see a qualified financial advisor if you're unsure about the risks. The value investments can go down as well as up. You may get back less than you originally invested. So past performance is not a guide to future performance. I will be talking about some past performance in this presentation, and it's really important to understand that some investments need to be held for the long term. Also, that forecasts aren't a reliable guide to future performance. So thank you for bearing with me. Those very important to do these things. So let's start by sort of saying, what is value investing? At its most simplistic form, value investing is about finding companies that are trading on the stock market below their intrinsic value. So really what we think that they should be worth. In contrast, growth investing, again in its most simplistic form, it's about investing in companies that offer high levels of growth. And what you've seen this year is a real rotation in the market from up until the start of the year. Lots of investors were really happy to pay sort of quite high multiples of earnings to own fast growth companies. And this year, everything's changed. Investors are less willing to pay up for these companies. And what they're doing, they're showing more interest in value stocks, because these high growth stocks, often the profits are not today, they're well into the future. And when you've got rising interest rates, that really affects sort of the way that they do the discounted valuations, looking at the value of these future cash flows today. And so investors are now saying, well, I don't want to pay up for all this growth. I think I might be quite happy to have lower growth, but actually companies that are generating decent cash flow and hopefully generating profits today. And so that's why you've got on your screen these jam jars, because you can summarize it as being value investing is jam today, growth investing is jam tomorrow, because this is very simplistic. And throughout these presentations and on our question and answer session, we'll go into them in a bit more detail. So let's start by thinking about stocks. Let's say you're interested in value investing. How can I find stocks that sort of tick the right boxes? Well, one of the first places people look for is stocks that have a low price to earnings ratio. You may have heard the term the PE ratio. This is what it means. And it's comparing the share price with the expected earnings over the next 12 months or so. You really want to look for a PE ratio of 15, or actually probably 12 or below. That's sort of generally the region that you find would be cheap stocks. Ratio, say, between 12 and 20 has historically been sort of fair value, kind of depending on what their industries are. And then anything above 20 for a PE ratio, typically being seen as either a bit pricey, or these are premium ratings because the business is doing something really special. And up until this year, investors have been quite happy to be paying 20, 30, 40 times earnings. Now, today, that's not so the case. So they're looking for the sort of this value territory where you have certainly sub 20 PE is much more interest to investors now. Not every industry should really be valued using a PE ratio. I think banks and natural resources sector, they've got very cyclical earnings. It's really quite hard to predict into the future what they'll be earning. So here, I think you might be better using the price to book value. And this is looking at a company's assets minus its liabilities, comparing that to the share price. There's two different ways that we can look at assets. One is tangible assets, which are things we can touch and feel. So property, sort of equipment, machinery. And we look at intangible assets, which are things you can't touch. So a brand or intellectual property would be a good example. Sometimes it's a lot easier to value tangible assets, things that you can actually see, rather than intangible ones. So that sort of muddies the water slightly when you're trying to do valuations on these companies. Back in the 1970s and 1980s, there was this reputation for asset strippers, companies that come in, find businesses that seem to be trading below their book value. And what they do is go in and buy this company, sell all of its assets, and just tear it all apart. And then hopefully there'll be money left at the end of it. Now, in today's world, there are still companies that go out and look for cheap things. May not be to completely break up a company, but potentially break it up into little chunks, and it might be worth more than the value of its together. You do just have to think that they will be looking for a price to book ratio below 1. That's sort of the key figure to look for. And another popular valuation metric, which also you want to be looking for a figure, 1 or below is ideal, is the PEG ratio. Here, this is comparing the price to earnings ratio with expected growth in earnings. Now, with all these ratios, it's probably best not to use them in isolation. If you find a stock that's on low PE, you still need to do some proper research. And our two fund managers tonight may comment on what they do to go, the metrics that they use to try and find opportunities. So we've talked about stocks. Let's move on to seeing this in practice. In recent years, value investing has gone out of favor. Yes, it's more in favor today, but perhaps the sort of the 5-10 years leading up to the start of this year, everyone was looking for growth and sort of assumed that if you had value investing, you wouldn't make any money. There is plenty of evidence to suggest that's not the case. Now, there's a financial data provider called Stockopedia. You can go on there and it's got some preset screens, and one of them is the Benjamin Graham Enterprising Investor screen. Benjamin Graham is sort of considered one of the godfathers of value investing, and what they do, they've taken his principles of an investment process and sort of apply it to the market today. And you'll see some of the criteria includes sort of a low price to earnings ratio and a low price to book ratio. And some of the names on the screen, you can see N Brown and Tandem. Some of these stocks have been up and down. They've had the problems. So you do have to consider that some companies are cheap for a reason, but what we're often looking for is sort of the catalyst to try and drive a re-rating so they would trade at a higher level. So the 5-year performance, according to Stockopedia, of this screen is 112%, which is very good, isn't it? So just to give you another example of another screen on Stockopedia is, excuse me, get this to work, the Piotrowski F-score screen, and this 5-year performance of this screen is 141%. So just very good as well. Piotrowski is an academic and looks for sort of the lowest price to book and mixes it with a health score for a company. So the F score is a ratio of 1 to 9. 1 is the worst, 9 is the best. And so just to give you an example of what might you find if you run this screen now, there's Virtue Motors, the car retailer, and you've got Mitchells and Butler, which owns Harvester, and various restaurants and pub chains. So I just wanted to give you an example just to show that whilst value investing does go in and out of favor, and perhaps that's something we can talk about a bit later, these screens are evidence that in the past you could have still made pretty good money. And of course, you must remember that what's happened in the past isn't automatically going to happen in the future, but it's just a good illustration. So let's move on to funds. When you're looking for opportunities for stocks, I think some people might be turned off by the fact you have to do quite a lot of work. So they would sort of draw on the services of a fund manager, an expert in their field, and happy to pay a small fee for them to do all the hard work. So if you go on to the Uinvest website, click the fund button, and then there's a fund screener. It's not a perfect way of trying to find value investing, but it's a place to start. When you're looking at this screen, there's a drop-down menu and it says Morningstar categories, and some of these categories will have the word value in their name. One example is the US large cap value. Now, this is kind of a crude way of finding funds, and I'll come to other ways in a minute, but to give you an example, on this list, if you look for funds with value in the name, you've got the T. Rowe Price US large cap on your screen now. This is an example. Look down the bottom of the product page. Here you can see there's a Morningstar equity style box. And what this is telling you for this fund in question is that the style is value and the size of the companies in which invest is large. So we know it invests in large companies and there's a value tilt to it. So this is one way, a little check whenever you're researching funds or trusts, you can use the Uinvest website to get a quick sense of the style. Now with investment trusts, if you do the same screener on the Uinvest website, unfortunately, you can't sort of go down to this sort of level in terms of finding trusts with value in their name. Just look at any product and you'll have the same thing, the Morningstar Equity Style box. So on your screen, you've got Temple Bar Investment Trust. That's telling us the same thing, value style, mostly investing in large cap companies. Now, as always, there's always a sort of an ifs and buts with these searches and these sort of these informations that we present to investors. The question is, can growth funds also have a value tilt? And the answer is yes, they can. Don't forget that growth funds can pay attention to valuation when they're looking for opportunities, even though they just might have growth in the name. So funds with equity is on your screen, very popular with lots of investors across the country. According to the Morningstar Style box, its style is growth and it's in large cap companies. But actually, if you look at Fundsmith's sort of mantra, it's saying one of the things is it doesn't overpay. Now, if you look at some of its holdings on a price to earnings ratio basis, you may think they all look pretty expensive, but it uses other metrics like free cash flow yield. So when you're looking for opportunities, it is worth having a good read of all their material just so you're comfortable in when you're trying to pick stuff, you know exactly what it's trying to do. Now, I've gone on to FE Analytics, FE Fund Info's platform. Now, here you can search by investment style. This platform is not particularly aimed at retail investors, but I thought it would be helpful if I did some of the screening to give you a head start if you're looking for opportunities here. So on your screen, you can now see open-ended funds, so unit trusts and OEICs. I've looked for the highest 10-year total return for ones that have a value investment style. So at the top, we've got Fidelity's UK Smaller Companies Fund. Other names are like UBS, US Equity. We've also got the Schroeder Recovery Fund on there. Now, one of our presenters tonight works for a sister fund, the Schroeder Global Recovery, and they'll explain exactly how they find opportunities. So don't forget, we will be sending you the links to these slides. So you'll be able to get this information if you want to look back at it after this webinar, and we'll get that to you pretty soon. If you're looking for investment trusts with value style, here's 5 examples for you on the screen. Aurora Investment Trust likes to invest in quite a lot of companies that perhaps you might think are either are broken or certainly need a lot of repairing, but that's kind of its style to find businesses it thinks are worth much more than what the market's valuing them now. AVI Global Trust has a bit of an activist investor slant to it. Fidelity Special Values and the Lowland Investment Company, the latter's run by Janice Henderson. And then we've got the Temple Bar Investment Trust. And again, one of our speakers tonight is fortunately with us here, and they're going to be talking all about this investment trust and how they look for opportunities. So I've just been discussing actively managed funds, but what if you wanted to have a low-cost tracker fund, so exchange-traded funds? You can go on to this website called justetf.com, and they've got a screening system there. Check that London is the one that's ticked for the ETF listing, because you only want to find London-listed exchange-traded funds. Under equity, there's a little box that says equity strategy. Go there and then select value, and that'll give you examples of London listed exchange traded funds that have a value tilt to them. So exchange traded funds are very simple to understand. They follow a specific index, which is a basket of shares, and that index follows certain rules. So it might be, let's say the FTSE 100. So that's 100 biggest companies in the London Stock Exchange. If that index moves up, let's say by 5%, the exchange traded fund should mirror this performance and do exactly the same thing. So on your screen, you'll see some examples of London listed ETFs with a value tilt. And what they're doing here is they take the index and then they overlay more criteria for the search that has links with valuation methods, such as the price to book and price to earnings that I was discussing at the start. Some names here like iShares, Edge, MSCI World Value Factor ETF. And what that is an iShares product, and it's tracking the MSCI World Index and overlaying some value factors on top. Now, one of the things you do need to be aware with these sort of factor ETFs is that history would suggest if they don't become big in terms of assets, the ETF provider won't think twice about potentially closing them down. Now, we've seen in recent years, people like Vanguard have actually closed down a value ETF just because it didn't attract enough assets. So I'd say anything from about 20-30 million pounds or under would be a territory where you do need to just consider, is there a risk that this product will just simply be wound up? Now, on this screen, you can see the iShares Edge World Value Factor ETF. It's got 4.4 billion pounds in assets. But at the other end of the spectrum, the Spider MSCI Europe Value ETF at the bottom of the screen, it's only got 22 million pounds. So just as consideration if you are looking at this area. So let's have a quick look at the iShares World Value Factor ETF. The average price to earnings ratio is 9. So we know that if it's anything below 12 is certainly really interesting from a value perspective. Price to book ratio is 1. So anything 1 or below is good. So you can see it automatically, it's ticking the right boxes for the sort of thing that we want with value investing. Got just over 400 holdings. So it's really diverse. Some names like Intel, Pfizer, Shell. So these are certainly not names you think to be broken companies. So I think that's a really important thing with value investing. It's not just about buying broken stuff and hoping that they'll be fixed. Quite a lot of companies trade on the stock market below what lots of other people think they're worth. Sometimes they sometimes need a nudge, or something particular has to happen for them to re-rate, trade more towards sort of fair value. Just finally, I just want to pose this question. Is the FTSE 100 actually a value index? There's lots of exchange traded funds you can buy that track the FTSE 100. Well, here we've got a market that certainly is not expensive at all on a price to earnings ratio, considerably cheaper than the US S&P 500. It's got the type of stocks you'd associate with value investing, so tobacco, banking, and sort of natural resources. So it's you may have thought, okay, this is just a mainstream index, but if you're looking for value opportunities, I suggest the FTSE 100 might actually have a lot of things that you're looking for. So thank you for listening to that just quick introduction to try and set the theme for value investing.